Good to see you both, guys. Thanks for being with us, as always. Welcome back.
Thanks, Carl.
You
Hi,
did
Carl.
trim your target earlier in May, but still would be looking for some decent gains going into year-end, right?
Yeah, I mean, we went from 5,200 to 49, so we're looking for a very healthy market from here. What was interesting about that, though, was we didn't change our earnings outlook at all. Earnings have been really strong. The only question is in this environment with a tighter Fed and wider credit spreads, whether the stock multiple would come in a little bit, and we thought they would.
Right. Do you think guidance in this earnings season has affirmed that view on earnings?
You know, it's really interesting. If you listen to what the companies are saying, they're telling you that the future looks horrible. And then when you actually look at the earnings revisions and the numbers, they keep going higher. And so it's kind of like, look what the numbers say, not what the management is saying, and it looks pretty healthy.
Lizanne, I'm curious. You say in your mid-year outlook, quote, we expect continued rallies like this one that led into Memorial Day weekend. However, for now, they are likely counter-trend rallies in an ongoing correction bear market. What do you advise investors to do here? Would you advise them not to be buying on at least some recent dips because of the potential for this rally to not be sustained?
First of all, there's no cookie cutter answer to that question, especially when you're dealing with individual investors that have ostensibly a wide range in terms of what their portfolio looks like, what their goals are, what their time horizon is. I think in general, we think it's not a time to take an undue amount of risk in portfolios. Again, in general, I think rallies look a little more ripe for trimming into than sell-offs look ripe for adding into. But it depends on how the portfolio is structured relative to the long-term strategic goals. So again, no cookie cutter answer. I also think that this is an environment where you want to focus on quality, sort of hybrid value, lowercase v value factors, but also look for positive earnings revisions and profitability. I think the low quality trade, whether it's meme stocks or non-profitable tech, the narrative-driven areas like SPACs, I think that's largely in the rearview mirror. You might get pops in some of these rally periods of time, but that is decidedly not where you want to focus for those stock-oriented investors.
Jonathan, on inflation, we just had prices paid come down a touch on ISM. Core PCE was a bit of a relief Friday. Some more homes are having price drops. We had retail inventories to the moon. Any question, in your view, it's peaked?
Well, it probably is peaked. The question is it going to a level where the Fed can take their foot off of the brakes? And the answer is no. I mean, you know, expectations for it's interesting. Expectations for inflation have fallen by a full % over the last 6 or 8 weeks, which is a huge decline. But you look at this ISM report, and it's telling you that there is no recession over the near term. The economy is moving forward. So I would take the over on the expectations on where inflation is going to be.
What about you, Lizanne? And let's add in, it's not just higher rates coming, but the Fed's finally starting to reduce the size of that enormous balance sheet. Curious as to whether you see any impact from that in the markets.
Well, we don't really know. This cycle is sort of a monetary policy orange compared to history's apples, given the attempt at simultaneously trying to reduce a $9 trillion balance sheet. And that's why the parlor game of how many rate hikes by year end doesn't make a lot of sense, because it needs to be inclusive of the impact of balance sheet shrink, which $500 billion of shrink is at least the equivalent of a rate hike. So it's the combination of the two. I do agree with Jonathan. I think it's going to take a while for inflation to come down to what is either currently the Fed stated target of 2%, or maybe they start to telegraph that they have a comfort level a little bit north of that. But I also think the Fed arguably has a credibility issue, and that they're not going to ease back somewhat prematurely until they truly get a sense that they've established some traction in reining in aggregate demand and the feeders into the inflation problem. All they can do is focus on the demand side. They can't directly go after the supply side. So I think it's still down the road before the Fed can truly pivot off the pretty aggressive stance they're in right now.